Well, that wasn't what anyone expected, huh? Stocks took a bit of a U-turn today. Everyone was gearing up for another record-breaking climb. It's crazy how the market can just keep you guessing, even with those little jitters.
Yeah, definitely keeps things interesting. Wasn't a full-on market crash or anything dramatic like that, but yeah, after the run of record highs we've been seeing, this pullback definitely raised some eyebrows.
So let's get right into it. We're doing our deep dive into CNBC's live market update from this afternoon. And from what I'm seeing, it seems like our old friend inflation decided to stick around a little longer than anticipated.
You got it. The September Consumer Price Index, the CPI, the one that tracks the average change in prices for all those everyday things we buy, well, it ticked up by 0.2%.
Okay, so 0.2%. Not exactly a huge leap, but I'm guessing that wasn't the number analysts were hoping to see.
Exactly. It's actually the lowest we've seen since February of 2021, which sounds promising on the surface, but it was just a tad higher than projections, and that's got investors wondering if the Fed, the Federal Reserve, might start pumping the brakes on those interest rate cuts everyone's been expecting.
So instead of a gentle easing off the gas, the Fed might be slamming the brakes.
That's the concern lurking in the back of everyone's minds. And we saw that reflected in how the market behaved today. The Dow Jones Industrial Average, it slipped just a little, 0.14%, to close at 42,454.11. And the S&P 500 followed a similar path, down 0.21% to end at 5,780.05.
And speaking of drama, how'd the tech scene handle the heat? The Nasdaq, always a bit of a wild card, isn't it?
The Nasdaq Composite actually showed some surprising resilience. It edged down just a tiny bit, 0.05%, finishing at 18,282.05. Now, this could mean a couple of things. It could be that investors see tech as a safer bet in this kind of wobbly environment, or maybe there's something else going on entirely. Market dynamics, they're rarely simple.
There's always another layer to peel back, right? Now, CNBC quoted Atlanta Fed President Raphael Bostic, and it sounds like he's open to pausing rate cuts next month. That doesn't really jive with what a lot of investors were banking on, does it?
Not at all. And this kind of statement, paired with those slightly warmer than expected inflation numbers, is like throwing fuel on the fire of market uncertainty. Investors, they crave predictability. When the Fed sends out mixed signals, well, let's just say it can lead to a bit of nail-biting and some interesting market swings.
So should our listeners be hitting that panic button? Time to head for the hills.
I wouldn't go that far just yet. Let's not forget, earnings season is right around the corner. JP Chase and Wells Fargo, they kick things off tomorrow.
Earnings season, the most wonderful time of the year. Always a thrill ride.
Tell me about it. And there's some interesting historical data to keep in mind. Oppenheimer, the investment firm, points out that the S&P 500 has a bit of a pattern. It tends to gain an average of 2% during those first 4 weeks of earnings season.
So this dip we're seeing, it might just be a temporary blip, a quick breather before the real party starts.
That's definitely a possibility. It's all about managing expectations, and staying informed. Those company earnings, particularly from those early birds like JP Chase, they'll give us a sneak peek into the financial health of different sectors.
And that's where things get really interesting. I mean, even with the major indexes taking a dip today, some individual stocks decided to throw their own little party. Netflix, they're on a roll, new highs, and IBM, get this, soared to an all-time high. Can you believe that? We're talking about a company that's been publicly traded since 1962.
It's pretty remarkable when you think about it. And it just goes to show that even when the overall market is taking a breather, individual companies, they can still have their moment in the sun. There are always opportunities out there for those who know where to look.
And speaking of opportunities, not every company was having a banner day, right? Pfizer, they took a bit of a hit, down 3%.
Yeah, they did. Seems like there are some legal accusations coming from an activist investor, and that's putting some downward pressure on the stock.
Yeah.
And this is a perfect example of why it's so important to look beyond just the overall market direction. You got to dig into those company-specific details. Positive earnings reports, new products hitting the market, or, in Pfizer's case, a legal challenge. They can all have a huge impact on a company's stock price.
It's like every company is its own little microcosm of the market, influenced by a million different things.
Exactly. And that's what makes investing such a fascinating and sometimes challenging endeavor. There are always new developments, new connections to make.
Now you're speaking my language. Okay, so we've got the Fed potentially tapping the brakes, earnings season about to kick into high gear, and all these individual companies navigating their own unique obstacle courses. Lots to unpack here, wouldn't you say?
Absolutely. We've only just scratched the surface. We still need to dive deeper into how different sectors might react if the Fed does hit pause on those interest rates and what history can teach us about navigating earnings season.
I can't wait. Stay with us, listeners. This is just getting good.
It's wild how such a tiny number, 0.2%, can really shake things up, huh? It all comes down to expectations.
Totally. It's like Wall Street collectively holding its breath, waiting to see what's next.
Exactly. And right now, there are a lot of mixed signals out there, especially when it comes to the Fed and those interest rates. So to circle back to your earlier question about what investors should be watching, I'd say keep your eyes glued to the Fed. Every word, every statement, every little hint they drop.
Like they're dropping clues to a giant financial puzzle.
Pretty much. Anything they say about interest rates, inflation, even their overall take on the economy, people are going to be dissecting it, trying to figure out what their next move will be.
And those moves, they can really impact different parts of the market in different ways, right? Not all stocks are created equal when it comes to interest rates.
Definitely not. Some sectors, they're way more sensitive to interest rate changes than others. Take growth stocks, for example, especially in the tech world. They tend to borrow a lot of money to fuel their growth.
Yeah.
So when rates are low, it's like a free-for-all. They can borrow cheaply, invest in new projects, boost their earnings. Everyone's happy, right?
But if those rates start creeping up, that party's over.
Pretty much. Borrowing gets more expensive, which can eat into their profits. And investors, well, they might start getting a little antsy. We often see something called sector rotation happen in those situations. Investors, they start moving their money out of growth stocks and into those more stable, defensive sectors.
Defensive sectors, is that like the financial equivalent of hiding under a rock until the storm passes?
Kind of. Think of things like consumer staples. The things people always need no matter what's happening in the economy. Food, household goods, that kind of thing. Or utilities. Those companies, they tend to do well no matter the economic weather. And they often offer good dividends, which can be really attractive when interest rates are higher.
So it's about finding those steady eddies, the ones that can handle a little turbulence. But besides watching the Fed and understanding sector rotation, what else can investors do to, not freak out when the market gets a little bumpy?
Well, I wish I had a crystal ball.
Yeah.
But honestly, one of the most important things is to focus on the fundamentals. Tune out all that noise and really dig into those company earnings reports. They're like a company's financial report card, showing how profitable they are, how well they manage their money, and if they're meeting those Wall Street expectations.
Back to school, but instead of pop quizzes, it's earnings reports.
Exactly. And with earnings season officially starting tomorrow, there's a lot of studying to be done.
JP Morgan Chase and Wells Fargo, they're up first, right? Do they kind of set the tone for the whole earnings season?
They often do. They're big players in the financial sector, so how they're doing, it's seen as a signal for the overall economy. Analysts will be listening to every word, looking for clues about loan growth, interest rate trends, what they think about inflation, and how much people are spending.
It's like the first act of a play. You get a sense of whether the whole thing's going to be a hit or a miss. And besides the big banks, what other sectors are on your radar this earnings season?
Well, tech is always one to watch, right? After they crushed it last quarter, investors are going to be looking to see if they can keep that momentum going, especially with those potential interest rate hikes looming in the background.
Like a sequel to a blockbuster movie. Will it live up to the hype?
Exactly. And then there's the energy sector. With oil prices all over the place, as always, it'll be fascinating to see how those energy companies are handling production, navigating those geopolitical risks. Ultimately, what does their bottom line look like?
So much drama. It's like a financial soap opera, but with real money at stake.
Huh. You've got that right. And it's crucial to remember that each company, each sector, they've got their own unique storylines playing out. There's no one-size-fits-all here.
Speaking of unique storylines, I can't help but think back to Hurricane Milton. It just goes to show you the market doesn't exist in a bubble.
Oh, absolutely. Unexpected things happen, natural disasters, geopolitical turmoil, even sudden breakthroughs in technology. These can all send shockwaves through the market, and they're tough to predict.
It's what makes the market so dynamic, so unpredictable. But with all this talk of uncertainty and potential volatility, should investors be, hiding under their desks?
Hide. No. Be prepared. Absolutely. Knowledge is key, right? When you understand the things that can move the market, when you dig into those company fundamentals, when you stay informed about what's happening globally, you're in a much better position to make good decisions.
So embrace the unknown, but do your homework first.
Exactly. And that's what we're here for, to help you navigate those complexities and hopefully uncover some opportunities along the way.
Speaking of opportunities, before we wrap things up, I wanted to circle back to something you mentioned earlier, those defensive sectors. If the Fed does decide to hit pause on those interest rate hikes, could those sectors actually be the dark horse winners in the coming months?
Now, that is a very interesting question, and it leads perfectly in the most important takeaway from today's market moves.
Okay, so we've talked about the Fed maybe hitting the pause button on interest rate hikes, those defensive sectors, and the always interesting world of company earnings. What's the big takeaway here? What's the one thing you really want our listeners to think about as they watch the market over the next few weeks?
It really seems like we're at a point where the old rules, they might not apply anymore. For years, it was all about what's good for the economy is good for the market. But does that still hold true? We're in a totally different world now, right? Technology's moving at warp speed, the global landscape is shifting, and the news cycle, forget about it.
Yeah.
It makes you wonder if we're looking at the market through, I don't know, an outdated lens.
Like using a paper map when you've got Google Maps and real-time traffic updates.
Exactly. So here's what I want your listeners to do. Don't just follow the herd. What worked for your parents, or even what worked last year, it might not be the winning strategy anymore.
So what's the alternative? What should investors be doing differently?
Be curious. Be skeptical. And most importantly, be informed. Don't just take anyone's word for it, not even mine. Do your own research. Dig into those earnings reports. Learn about different sectors. Understand what's happening in the global economy.
Become your own financial detective.
Yes. And remember, every time the market dips, every time there's a surprise announcement, even those head-scratching inflation numbers, those are all learning opportunities.
It's not about seeing the future. It's about understanding the now, right? And making smart decisions based on the best information you can get your hands on.
Exactly. The market's always going to have its twists and turns, but the people who stay informed, the ones who can adapt, those are the ones who will come out on top.
I love that. Well, on that note, I think it's time to wrap up this deep dive. A huge thank you to our expert for joining us and sharing those awesome insights. And to you, our listeners, thanks for being here. Remember, knowledge is power. And in the world of investing, there's always something new to learn. Until next time, happy investing, everyone.